The second half of 2025 is now upon us. And depending on who you ask, we are about to enter a period of rapid growth, or the doom of debt spending will ravage the United States. Will rates finally get cut? Will tariffs lead to unsustainable inflation? Will a new golden age be ushered in by AI? Nobody really knows the answers to these questions, but what we do know is that some businesses are set to thrive for the rest of 2025. Welcome to The Quality Investor. Right now, the market is trading fairly high. Depending on the source, it's between 25.6 and a 28.9 PE ratio. The 5 and 10 year rolling average PE ratio is about 20 to 21. So we're definitely hovering above that, and the fact we're hitting all-time highs in the market almost daily now shows us that the market is racing upwards. But what's really interesting is that going back to the early 1980s, the PE ratio of the S&P 500 was as low as 6.7 and was below 10 from 1977 to 1982. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. It has been trending steadily upwards ever since. While not as high as it was during the dot-com bubble, when it reached 46.5 at the top, it is still historically very high. So what does this tell us? Well, I heard an interesting take on the issue from Dev Kantesaria. I'll link to the podcast in the description. He was discussing how valuations today seem high, leading many investors to prognosticate that we're in a potential bubble. But he provided some clarity. I'm paraphrasing here, but Dev Kantesaria pointed out that studying the mix of businesses in the S&P 500 back in the 1980s compared to the mix of businesses today, you see a picture that is starkly different. In the 1980s, the index was heavily weighted towards industrials, energy, and to a lesser extent, basic materials. But this shifted by the late 80s and 90s as the US economy underwent rapid transformation to an economy dominated by the financial sector and the tech sector. But why would the S&P be higher despite this? Well, the aforementioned sectors of energy, industrials, and basic materials all suffer from low margins and high cyclicality. Basic materials can be easily commoditized. Energy is notoriously cyclical, and all three require heavy reinvestment to sustain their businesses, let alone grow. And on growth, they are all slow growth sectors. There is only so much innovation to be had with a can of paint. The financial sector and tech sector, on the other hand, are high margin and grow like crazy. At its most basic, investors are willing to pay a higher price for high margin, rapidly growing businesses. Full stop. The tech sector now makes up 33% of the S&P 500. Financials are at 14%. So together, these two sectors make up nearly half the index at 47%. So it is important to keep this in mind when evaluating the market at all-time highs. As Dev Kantesaria points out, the mix of businesses in the index today simply have better margins and forward growth potential than the businesses in the index 40 years ago. And on that note, I want to discuss 3 businesses that are set to thrive in the second half of 2025. These businesses are all at the forefront of either AI applications or developing the technology to power the AI revolution. And without further ado, let's get into it. The first business on our list today is Applied Materials, ticker AMAT. You can see here Applied Materials has been a little bit slow growing the last few years. You see the revenue in the last 1 year has only grown at 2.5%, and on a 3-year basis, it's grown at 5.6% annually. Part of this is due to the typical cyclicality of the semiconductor industry, but Applied Materials is at the forefront of developing the technology to power our AI world. I've, of course, done multiple videos on Applied Materials, but they are well positioned to capitalize on the growing demand for all those advanced chips, especially those NVIDIA advanced chips that are driving AI, as well as making equipment that can create the chips for automotive applications in AI, as well as manufacturing process improvements using AI. And honestly, I believe a lot of the initial AI opportunity, at least what we can see over the next few years here, lies in three areas: process automation, full self-driving, and research-intensive occupations, think medicine. Well, Applied Materials manufactures the advanced equipment necessary to create these high-performance chips. And you can see from a financial performance, they are doing well. I did mention the slowdown in the revenue growth, but we should see that start to take up over the next few years. They have a very healthy debt-to-equity ratio. Their free cash flow has lagged a bit over the last couple of years, but again, once they get back into a high growth phase, that should continue to compound. But they also buy back a large amount of their shares, and they're paying a growing dividend. On the margins, however, this is where Applied Materials really shines. You can see that they've done a very good job over the last 10 years of consistently increasing their margins, both the gross margin and the operating margin, thus adding value to the bottom line for Applied Materials. And this has resulted in an increase in ROIC, trending upwards over the last 10 years, although it's lagging a bit in the last trailing 12 months. However, it's still a very healthy 30.8% for the ROIC and a 29.1% for the ROCE, or return on capital employed. So why is it set to be a good buy for the rest of 2025? Well, they just closed at $191.05 heading into July 4th weekend. But as you can see, right now the market is pricing in free cash flow growth of almost 3%. And on my valuation, I'm pricing in free cash flow growth at 5.9%. So while they have gained 17% year to date, and they've definitely had a very good last 3 months, I still believe there's a lot of room to run for Applied Materials. They've done a very good job of shifting their revenue base away from China into other Asian countries, adapting well to the semiconductor export restrictions. And they should also benefit from the fact that there are tariff exceptions for semiconductors issued by the Trump administration that continue to support the growth of this vital industry to the United States strategic position. But all in all, demand for AI isn't going down. As fabrication plans for TSMC, Intel, and Samsung continue to come online, they're only going to need more equipment, and Applied Materials will be happy to serve them. Now that said, I'm actually projecting very conservative revenue growth and free cash flow growth over the next 10 years for Applied Material. My base case revenue growth is at 7%, and my base case free cash flow growth, as you can see, is at 5.9%. On a bull case, I have revenue growing at 8.5% and free cash flow growth also at 8.5%. So we can see a DCF price here of $185.92 up to $280.70 for the bull case. Now with a 20% margin of safety, they're trading right around that right now. Now Applied Materials has been volatile over the last couple years, so it's very likely that that price will come back down below 190 on a fairly regular basis. And if you have a 10% margin of safety for this business, it's still a good buy, coming in at a target there of $215. The second business we have today is one I have not talked about much on this channel, and that is Salesforce, ticker CRM. Salesforce is a business that has been a little bit out of favor in the market recently. You can see that year to date, it's actually down 18.6%, and on a one-year basis, it's only returned 4.3%. On a 10-year annual basis, it has returned a very nice 14.5% per year, but we'd expect Salesforce to do a little bit better than that. Investors have a couple complaints about Salesforce, one being a slowdown in revenue growth. You can see that on a 10-year basis, Salesforce has grown their revenue at 21.6% annually, but in last year, they've only grown their revenue by 8.7%. And in this fiscal year, they're expected to grow their revenue by about 9.5%. Of course, any sort of slowdown in revenue growth tends to spook the market. In my view, a slowdown in revenue growth comes along with a business becoming mature. And another sign of a business coming into maturity is that they start issuing dividends, which Salesforce started to do in their fiscal year 2025. And beginning in fiscal year 2024, they started buying back shares. So Salesforce is a business that has grown fast, but is slowing a little bit as they come into their maturity. But I still think the market is undervaluing them. And one of the other reasons for the negative market sentiment is around Salesforce is similar to what Adobe is facing. And that is they've been slow to monetize their AI offerings. Now, if we're being honest here, has anybody really figured out AI monetization yet? And before you say NVIDIA, they're making the hardware that supports AI, but AI monetization in the sense of Adobe's Firefly or Salesforce and their Agentforce is a little bit different. Right now, there's enough free offerings out there. It doesn't make a lot of sense for people to upgrade to these paid subscriptions. And even then, I view a lot of the opportunity around AI, like I said with Applied Materials, to be sort of behind the scenes right now in process automation, full self-driving, not necessarily where we see it out front and center with everyday customer interfacing with a product like Einstein AI or Adobe Firefly. Now that said, Salesforce, of course, is going all in on AI. Just last week, the CEO of Salesforce, Mark Benioff, stated that AI is actually doing 30 to 50% of the work at Salesforce, particularly in the areas like software engineering and customer service. And one of their big selling points is an AI product that aims to handle customer service without any human intervention, and they're claiming a 93% accuracy. The point is, AI is big right now, and Salesforce is trying to capitalize on that. But in my view, the market's woefully undervaluing them. They are still growing, and I expect them to continue to grow at least 9 to 10% per year. You can see they're compounding free cash flow at an excellent rate, and very importantly, they're very capital light. So they don't need a lot of reinvestment back into their business to continue compounding their cash flow. And when we look at Salesforce's margins, we can see things get even better. And you can see right around fiscal year 2024, they really started increasing their margins, with gross, operating, and free cash flow margin all popping. And a big part of this was they really started to focus on operational efficiency around that time. They reduced a large part of their workforce, they had restructuring, and when it comes to sales productivity, they shifted a lot of their business to the higher margin subscription revenue and also upsold premium features to improve the data offerings to their customers. So this has improved a lot of the underlying fundamentals for Salesforce, but the market is still hung up on their slow AI monetization. Salesforce headed into the long holiday weekend at $272.15. Now the market, they're saying that their free cash flow growth for Salesforce over the next 10 years is going to be at 2.9%. My model has them at 9.2%. And for reference, I have their revenue growing at a base case of 8.23% and their free cash flow growing at a base case of 9.2% over the next 10 years. The bull case revenue is at 9.3% and the bull case free cash flow is at 12.3%. So you can see a DCF price here for Salesforce at $348.73, up to a bull case of $563.36. They do pay a tiny dividend. Right now it's at $1.66 per year. They had very tiny 4% growth over their last year's dividend. So it's kind of hard to predict what kind of growth we'll see out of their dividend. I have it anywhere from 5% on the bear case up to 12% on the bull case, which is why we see a wide range of dividend discount prices here. But ultimately, with the 20% margin of safety, that gives us a buy price for Salesforce at $285.33. Like I said, Salesforce has suffered from negative market sentiment around their AI monetization, much like Adobe. And because of that, their share price has been kept down a bit. But I fully expect Salesforce to continue to post strong earnings growth and strong free cash flow growth, which will continue to drive their valuation. And lastly, we're looking at Google. I still believe Google is by far the best play in the market. I've been pounding this drum now for a while. Google is still down over 5% year to date. On a 1-year basis, they're down just under 3.5%. But on a 10-year basis, they've returned 20.7% annually. And if we look up here at the revenue, we can see on a 10-year basis, the revenue has grown 18.2% annually. On a 3-year basis, that revenue has grown at 10.75% annually. But in the last 1 year, that revenue has grown at 13.9%, meaning they're re-accelerating their growth. Google, of course, is a cash flow machine. And you can see here they've really intensified their capital spending in the last couple of years as the AI wars in big tech have ramped up. But despite that, they're still generating nearly $75 billion in cash flow on a trailing 12 basis. They've also started to pay a dividend, which is going to grow, and they're buying back shares. Again, Google is a business that has entered maturity, but they're still a fast-growing business. Of course, the complaint with Google is that their core business, advertising, is being disrupted. The likes of ChatGPT are going to come in and steal all of Google's search revenue. If you've watched any of my videos on Google, you know I think those fears are way overblown, and the real bull case for Google doesn't lie in their search, which is still growing to over 10% annually, by the way. It lies in their cloud, their Google Cloud Platform, and in YouTube. And one more point on Google's search revenue, specifically the advertising revenue. Let's have a look at this tweet here. Google owns the attention stack. Google and YouTube pull more traffic than the rest of the top 20 combined. And yeah, ChatGPT just passed Wikipedia. Let that sink in. So what is this telling us? Well, if we look at America's most visited websites, Google dominates at 16.3 billion visits. And what do we know about advertising? What do they want more than anything else? They want eyeballs on their product. Well, Google commands eyeballs by far, 16.3 billion. And guess who's number two? YouTube at 5.4 billion. Who owns YouTube? Well, Google does. Facebook, whose entire income stream comes from advertising, is at 2.44 billion views. And you know what? The market loves Facebook right now. But ChatGPT hasn't even reached 1 billion average monthly visits yet. They're still at 750 million. Now, of course, I expect ChatGPT to grow, but I also expect Google, with their seemingly infinite resources, to adapt to this new world. And adapt they have. Please see my video on Google about how they're adapting their search business to AI, but more importantly, why the real bull case for Google lies in Google Cloud Platform and YouTube. But looking at Google's margins, you can see where that Google Cloud Platform case is starting to play out. They really became profitable over the last couple of years, and you can see what that has done to their operating margin. It has started to really shift upwards since fiscal year 2020, both the gross and operating margin. Their free cash flow margin has suffered a little bit, but that's due to the higher CapEx spend that they've been doing over the last couple of years. But one thing to understand about Google Cloud Platform is it's a high operating leverage business. And as it continues to scale, remember, it's the third largest cloud platform right now behind Amazon and Azure. But as it continues to scale, it's only going to become more profitable. And in my estimation, again, see my video I did on Google, I believe that YouTube is a bigger business than Netflix. Well, YouTube and GCP are two just small parts of Google's overall business. So I think there's a lot of value ready to be unlocked in Google. I think we're going to continue to see very strong earnings out of Google. And I think the market will be forced to catch up as Google continues to post strong numbers. And you can see they've also had a steady rise in ROIC and ROCE over the last 10 years. Google closed into the July 4th weekend at $179.53. The market, however, is pricing in free cash flow growth over the next 10 years of 7.5% for Google. Whereas on my base case, I have them growing at about 12.3% in free cash flow over the next 10 years. My base case revenue growth for Google is at 8.5%. My bull case revenue growth is at 11.2%. And my bull case free cash flow growth is at 16.1%. Unlike the market, I am quite bullish on Google. I have a bear discounted cash flow price of $197.86 up to a bull price for Google at $347.33. Like Salesforce, Google has just started paying their dividend. It sits at 83 cents per share and only saw about a 5% growth from the previous year, but I am estimating growth on the bear case at about 6% up to 15% on the bull case, which gives us our wide range there for the dividend discount price. Ultimately, however, with a 20% margin of safety, we have a buy price for Google at $202.76. So I still think there's a lot of room to grow for Google. And like I said, I think this is the best value stock in the S&P 500 right now. I believe what they're doing with GCP and YouTube is very underappreciated by the market. And while everyone says search is being disrupted, we haven't seen real evidence of that yet. Although I'm not going to say it's not going to happen. I'm just saying I want to wait to see real evidence of this happening in their earnings. And even if search does slow down a bit, which it very well could, I believe the growth that we're going to see in GCP and YouTube will be more than enough to overcome that area of the business. So those are the 3 stocks for you today: Applied Materials, Salesforce, and Google. I believe all 3 of those will have a very good second half of 2025, and I will check in on this prediction at the end of the year to see how I did. Thank you for watching today's video, and if you've made it this far, go ahead and subscribe to the channel. Thank you, and happy investing.